Okay, so this is going to be the official members webinar for Tuesday, May 1st. And what I'm going to do is just give you a preview of my next public presentation on essentially what I do. I figure it's a good way to, kind of get the background of what I'm doing, and maybe it'll help give you a better understanding of what we're trying to achieve here. So basically, I'll usually start off with, did this method warn of this decline? Looking at the decline that started from the January 26th high in the S&P cash. And anybody want to make a guess? You might know the answer already. Yeah. So, basically, there were some timing factors in this case. Okay, because a lot of people think there's no rhyme or reason to the market, and sometimes there really isn't, or at least I can't find it. But I would have to say that there are things that you can find and patterns that you can find that repeat themselves over and over and over again. And that's basically what we're here, to look at, to try and make money with these markets. So essentially, it was timing more than anything. And it was by comparing the high-to-high swings in the market, I saw the similarity. There was a prior high-to-high that was 24 weeks. There was another high-to-high that was 28 weeks, another high-to-high that was 23 weeks, and then the high-to-high into the January high was 24 weeks. So we had the cycles with the high-to-highs, and we also had a couple of other cycles that had come in, around that same time. So, we had a heads up for a long time because, overall the market was extremely extended, and it's just kind of like waiting for, well, when are we finally going to get a correction? But there was some rhyme or reason to it, and that's where it came from. And then we're going to go actually into the basics. So big question is going to be, why do you want to use this type of Fibonacci analysis? And we're going to say because it enables you to identify high probability, relatively low risk trade setups where the risk is clearly defined along with the targets. Okay, basically the raw material for trading, whether it's going to be a swing trade or a day trade. Now, as far as the work is concerned, it works on any time frame and essentially any good market data. But you can't ask me to analyze an IPO that has, a couple hours worth of trading on a 5-minute chart. Okay, that's not what this is for. As far as, what you can apply it to, I've worked on stocks, ETFs, futures, and the Forex markets, and it works on all of them. It's also an excellent methodology to use with options strategies where your risk can also be clearly defined. You can see some things in the market that you will never ever see using indicators by themselves. For those of you that are not familiar with the numbers series, this is just the series that, as you add the prior two numbers in the series, it gives you the next one in the series and so on out to infinity. And what's really important here is that in between those numbers is where we find the golden ratio, 618 or 1618. And then the rest of the ratios that I use in the analysis are also related to the 618 and the 1618. Okay, so these are the ratios that I use every single day. For a confirming ratio every once in a while, or for a very, very large move, I might use 236 as a retracement. I use 2618 as target number 3. It is very rare, but every once in a while you'll just get a market gone wild. And if you run the extension and you've gone beyond 1618 and 2618, this would be the next ratio that I would look at. But just remember, I don't use it all that often. So again, 618 comes in between the number series, right? But where some of the other ratios come from, and again, you don't have to know this stuff, but some people are curious. For example, the square root of 618, if you mess with it on your calculator, is 786. Square root of 1618 is 1272, which is also the base to the height of the Pyramid of Giza, which is just, a fun fact from a book called Geometry of Markets by Bryce Gilmore out of Australia. Anyway, and then there's a couple of other ratios and where they come from. So they're all related mathematically. So we're going to start with, the tools that I use. We're going to start with the price tools. Okay. So again, this is going to be super basic for some of you, maybe not for others, but for possible support, you're going to run the lows to the highs using the ratios below. So you're going to measure all prior low to high swings and use these retracement ratios to look for possible support. If you're looking for resistance, we're going to measure the prior highs to lows using the same ratios and looking for potential resistance. So I finally updated some of these examples because I've had a lot of really old charts in my presentations before. Not that they really needed to be changed, but still even some of the symbols, people wouldn't recognize. So I'm giving you an example of a retracement in square. This is a daily chart. This is where I would measure the prior low to high swing and run the retracements, those levels I gave you, the 382, the 50%, the 618, the 786, right? And I'll challenge you to which retracement do you trade against? Well, there's a couple of ways to refine which ones that you might trade against, because you don't want to be a buyer here, hope it holds, buyer here, hope it holds, buyer here, oh, it finally held, awesome. You basically want to either combine it with other ratios to identify a cluster that you can trade against, or you can just use a level. If you're going to use single levels by themselves, use that with a trigger, because the trigger is what will tell you that it's worth placing a bet against that zone. Okay, but personally, I'm not really going to use any single levels unless it's some major market, major swing. Then I might pay attention to it, but otherwise I'm looking for clusters. All right, so now here's another example of a retracement, but it's coming from a high to a low. And this includes actually the 236. There was really no reaction off of the 236. There was a reaction off of the 382 by itself. Fell a little bit short of, the 50%, but you did have a major high at the 618. So again, what's going to tell you that this is the one that should hold? You either use a trigger against it, or you set up a cluster, or you let me set up a cluster. So that's just the simple explanation for the retracements. Now, price extensions are essentially retracements beyond 100%. So in the same way that I would take a prior low to high swing and run the extensions down, I'm looking for possible support using the ratios of 1272 and 1618. If I'm running a prior high to low swing and projecting from the low, and I'm just using 2 points in this case, I'm going to look for potential resistance at the 1272 and the 1618. Okay, that's pretty much what I use all day long, as far as price extensions. I will show you the 2618 when I'm looking for a target number 3 in the, in any of these markets. So examples of extensions. One of the things that you'll hear me say very often is many moves tend to terminate at extensions of prior swings. Now in this case, in this daily chart of Facebook, I'm going to show you multiple examples of where we've terminated moves around or near extensions. This high to low First terminated here, just short of it, and then terminated here again when it retested the extension. Didn't do anything at the 1618, but it did there. Then, if you take this high to this low, you can see we didn't really have a reaction at the 1272, but the 1618 topped it, or capped it. Okay, so there's more than one decision on here that shows you why we want to ratchet up stops as we get near extensions of prior swings. But the resistance was calculated by running a prior high to low swing and extending upwards. High to low swing, extending upwards for resistance. Here's another example. Here's where in Intel on a daily chart, I measured a prior high to low swing, and then it blew through the 1272 and pretty much topped. Actually, this was an exact hit. Okay, so if you would have measured this decline, which was 520 times 1.618, and then added that to the low, you'd come up with the high that was made at 50.85. So again, really important times to ratchet up stops. As soon as you start to get into the territory of the 1272, it's a really good time to ratchet up stops. All right, so that was actually resistance. This next chart is an example for support. This was on a weekly chart in CMG. So in CMG, this is where I measured a prior major low to high swing. This swing was a $146 swing, okay? And then ran the extensions 1272 and 1618. So 1272 stopped for maybe a day, but didn't really give you much in the way of a reversal signal. And the 1618 came in at 262.71. The actual low was 263 even, and that was 236 points, or dollars, dollars, from that last high. Okay, so again, reasons to watch for termination of a move, extensions. Okay, so both the retracements and extensions come from 2 points only, you know, in whatever program you're using. But the Fibonacci price projections come from 3 points. And this is where I'm going to measure a prior low to high swing projected from the low using 100%. That's always for symmetry, and sometimes 1618. So if I'm measuring a low to a high and projecting from another low, I'm looking for possible resistance. But if I measure a high to a low projecting from another high, I'm looking for possible support, and I'm going to use these same ratios. Okay, so it's kind of screwed up in Thinkorswim because Thinkorswim calls this an extension tool. It's the one that you use with 3 points to run what I call a projection. So it doesn't matter what you call it. If this is what you're trying to do, if you're trying to run symmetry, you need a 3-pointed tool in whatever program you're using. So here's an example of a price projection. This is in crude oil. This was a daily chart. This was earlier this year. And here's an example of a projection. This is where we measured a prior high to low swing. That was $3.12, and projected it from the next high. And that gave you 55.87. The actual low is 55.88, which is $3.11 from the high. Okay. In this example, there were more projections to run, but I just wanted to show you an example of one in this case, so you get the concept of what we're doing in comparing the swings in the same direction. Okay, so that's a price projection. Okay, here is another example of a price projection. This was an old S&P chart. This is where I measured a prior low to high swing, projected from a new low for possible resistance using both 100% and 1618. 100% didn't stop the market, but 1618, we were just short of that. So, you know, that essentially made the high for the move. So that's just another example for a projection from 3 points. And then this next one is in Google on a 60-minute chart. This is where I've measured a prior low to high and then projected from another low using both 100% and 1618. So at 100%, we really didn't stop the market. You actually gapped above it. But the 1618 did offer resistance. Okay, it did cap the move, at least temporarily. So that's another example of the projections. Okay, one more, and this is what I'm doing every single day when I'm running, especially when I'm running the shorter term charts. And that's where I'm using symmetry in the direction of the trend to help you get involved in the market in the direction of the trend. So for example, if you have a pattern of higher highs and higher lows, you're going to want to set up the buy side if you're a trend trader. So this is where I will compare the prior declines within the uptrend to the current decline. So let's say we were coming from point C and you projected down from there. Okay, you basically took point A to B and projected from point C for possible support. And in this case, you know, I'm just showing you the comparison with these two swings here. This was $1.30 and this was $1.30. So if you knew that we had symmetry here and it was pulling back and it was an uptrend, you're going to try to be a buyer, right? And then typically for any of these setups, your initial upside target's the 1272 of the swing into the zone, and then the 1618, and then the 2618. Okay, so again, that's coming from 3 points. This next chart is just an example why we want to watch and compare swings in the same direction. Now, this isn't a trending swing. I mean, as far as we're not looking at declines within the uptrend. We're looking at the similarity in the trend swings themselves. And this happened where you had a rally of 373.21 in Amazon, and you had another rally of 373.21, and from there it dropped $151. Okay, now it didn't happen again. I did run the projections for the next one, and instead we stalled at it like temporarily, and then we blew right through it. But when it does hit and hold, then you know you have definition of risk to take a trade against. Okay, so that's Amazon. NASDAQ, okay, so this is some of what I used for Kramer's show. Similarity, you know, and a lot of times we're going to find some setups on the weekly chart that you'll never be able to see because you don't have the perspective from the, you know, daily chart. I'll use the weekly chart to, you know, see the bigger picture patterns. And this symmetry here is gorgeous. Okay, you can see how similar these swings are, and there's even another swing that shows up way in the back on a monthly chart, and I've shown you that one recently. But bottom line, that's what gave us this low as potentially important. And so far, I mean, or at least initially, you saw a huge rally off of that area with the risk definition just either underneath that low or underneath the low end of the zone. This next chart is another example of symmetry, and I'm spending a lot of time on it because it's so damn powerful. It is simple as far as a concept, but it is so powerful when you apply it to the market. So here, this is a weekly chart of GLD, and if you compared the declining swings in the same direction, so this is not trying to get in with a corrective move, but this is just comparing swings in the same direction, because many swings in a particular market tend to be similar to others in that same market. So if you saw that these prior declines lasted 25.47, 23.09, 24.02, if you project all of those from the new high here, it'll give you an area to anticipate the termination of that move. Okay, so this was definitely way similar to this swing of 25.47. So those are the tools that I use as far as all the price analysis. Now, the most powerful trade setup is called the Fibonacci price cluster. And the definition is the coincidence of at least 3 Fibonacci price relationships that come together within a relatively tight range. Okay, so most of you should know that. So here we start with a blank chart, and you'll say, or I'll say, what would have told you that this was a key high? And nobody's really supposed to know the answer. You might take a guess, or you might remember the setup. But this is what we start with. On the daily chart of IBB, I had a high-low. There was a 786 retracement that came in at 115.39. On the same chart, we had a 100% projection of the first rally swing of $10.92 from this pullback low. That gave you 116.08 as a projection. And then we also had, on the same chart, prior high to low swing, 1618 extension came in at 116.13. So we had 3 price relationships that came in for this setup zone of 115.39 to 116.13. A 786 retracement, a 1618 extension, and a 100% projection. Which was followed by, and again, I did not know that it would roll over and die. I just knew that it was resistance, and if you saw a sell trigger, that you could take a trade against it. So you don't have to know where the market's going to go. You just have to trade the setups. And you have to be disciplined. Okay, that's another thing. So then the next question is, so how do you trade it? And hopefully most of you already know, but I like to see what I call a trigger to tell us that it's worth placing a bet. And for this, we go down to a lower time frame chart. Why? Because you want it to trigger as close as possible to where your risk definition is. So this is actually just an excerpt from the trading plan. So, you know, this is for swing trade triggers. You can use a 15-minute chart for an aggressive entry, but it will get stopped out more often in the same way like it did today in Goldman Sachs, because it triggered on a 15 and it didn't trigger on a 30. And the 30 won't get stopped out as much. But the trigger is essentially, well, for a buy, it's an 8 EMA crossing above the 34 EMA. And I also want to see for double confirmation that a prior swing high is taken out, because it's basically illustrating a shift in pattern. So I like to watch both of those things and wait for both of those things to occur. And then you just reverse it for a short. So here's an example. If you looked at, you know, this is where we made that high in the IBB. This is a 30-minute chart. So when we both took out or had the moving average crossover, which was down here, since you always need to see the crossover, what you can do is you can wait for that and then just look to the left and see, did it take out a prior swing low? Because what this is essentially doing is, you know, it's shifting from a pattern of higher highs and higher lows to taking out a prior low, which means the new pattern could be lower lows and lower highs. Okay, but that's an example of a trigger. Let me see if that was just, yeah. Okay. these other examples are just examples of why I use symmetry, because it's so simple yet so powerful. This was a Netflix weekly chart, and let's see, this decline was 27.35, 27.27, and 26 bucks. Those swings were all similar. So at least these two times it gave you a trade that was worth a lot of money. This first swing up was 40 bucks. This swing up was insane. 108 bucks. Okay, simple symmetry to define risk. All right, here's another one with symmetry, and I've talked about this one recently. If you go back and you look at Goldman Sachs and you count the weeks, this was a trade, quite a while ago, but besides the fact that I had 1, 2, 3, 4, 5 price relationships in June of 2017, you also had time symmetry there with a decline of 13 weeks, 14 weeks, 13 weeks, 13 weeks. Time and price came together. Okay. Now, as far as the current decline in Goldman, we're not anywhere near 13 weeks, but we do have other timing factors that may be in play here. Here's another example of symmetry. This was in Amazon on a daily chart. Here's where one of these prior declines was 89.5 bucks. And I would have run all of these declines from, the new high at that time. But you can see that this was very similar at 88.67. There were 3 100% projections. 1 786 retracement, 1 382 retracement, 1 1618 extension. Followed by a rally of $373. Now, I'm not going to tell you that I bought it here and sold it here. There's no way in hell. I don't keep trades that long. But was there support here, and did it trigger a buy entry? And depending on how you managed it, you could have been in it for that long? Yeah. It's quite possible. Actually, I know at least of one person. But it wasn't me. So, Expedia. This is an older setup, but it gives you an idea of what I'm doing as far as the swings to come up with these clusters. In this case, all the blue lines are retracements. I had a 50% retracement, I had a 618 retracement, and I had a 786 retracement. The red lines were symmetry projections. That high to low and that high to low projected from here, and then also this high to low projected from here. Then I also had an extension. This low to this high extended. 7 price relationships. Just because I had 7 didn't mean it would hold, but it meant it was an important decision. So that's what you need to know. So that was a setup plus trigger equals trade entry, and then you manage it. Okay, here's the $64 rally in Tesla. Where did it come from? If you looked at the daily chart looked like absolute garbage. None of the moving averages were on the right side. But if you backed it up and looked at the bigger picture, there were a couple things that you saw. This decline of 28 weeks was getting very similar to a couple of these other declines of 29 weeks. And this swing down was almost equal to this swing. And there was also a 618 retracement of the major swing. So I stated that it was a counter-trend decision. There was also timing. So the only time I allow myself to do a counter-trend trade entry is if there's also timing factors. Okay? So that one, again, we started small here, and next thing you know, there was a $64 rally in Tesla. Okay, this next example is win on a daily chart, and it's a pretty old one, but you know what? It was a public trade setup that I put out, but this is on the old site, so this link probably won't work anymore. But there was, you know, a two-step pattern in a support where you had two 100% projections, 1618 extension, 786 retracement, 618 retracement. Beautiful cluster. Didn't know if it would hold or not, but when it traded in that area, if you went down to a lower time frame chart, it would have triggered an entry for you. That was a really nice, healthy rally off of the two-step. Typically, your target off the zigzag is just going to be the 1272 extension first, then the 1618 next. Okay, here's Goldman Sachs on a 30-minute chart. Let's see, whoops. Ah, yeah, this is a good example. Okay, so here in Goldman, we had a ton of support between 250.240 to 252.72. Okay, now here it only went slightly through it, so I was still willing to, you know, look at it and say, well, you know, a few or 20 cents or whatever doesn't negate the setup. And we did rally, but obviously this is one that would have been stopped out. So yeah, I guess we were supposed to look at this one first here. I can get this going. Yeah, so this was like, you know, the original setup, because if you looked at it before the break, there was some gorgeous symmetry here, and it easily could have held and resumed the rally. But guess what? When it doesn't do what you want it to do, GTFO. That's something that I say all the time also. You know, get the heck out of the way. All right, and then the last few slides, because then I can take questions after this, but the last few slides show you the last few timing clusters that we looked at in the S&P or the NASDAQ. So timing, I'm basically measuring between highs to highs, highs to lows, lows to highs, all that good stuff. And if I see a cluster, whatever the market's doing into the time cluster is what you're going to look for a reversal of. Now, if the market is sideways into it, it has no predictive value. But since we were trading straight ass down into April 2nd through the 5th, we wanted to anticipate a low and a reversal back up, which is what we got. The next example is when we ended up putting in the highs right around the 18th. Wait, it was the 17th. Oh, this is Apple. Sorry about that. Oops. Let's go back to that one. So in Apple, okay, I've got to quit hitting the wrong buttons there. Let me go back to it. Slideshow. Yeah, I've got to go all the way to the back of this. Okay, so in Apple, in the case of Apple, you know, Apple was looking great for a while. It had price above the 200. It got price back above the 50. And it had the 5 and 13 in a buy mode with the 5 above the 13. So it looked like we were going to head towards this target. And that's a natural thing that you would look for. But when you had a cluster of cycles, in this case, 16th, 19th, 16th, 17th, you want to ratchet up stops just in case the timing kicks in. Okay, so typically I'm more focused on the timing if we are, let's say, for example, making a full extension into a target and then there's time resistance, then I'm definitely watching for a possible termination in the move. But you still want to be aware of these cycles you know, if you're getting a directional move in, you know, the stock or the index or the ETF or whatever you're looking at there. And then this is the last one that I put in this particular presentation. I might actually go and show the next one for the money show. But here, if anybody remembers, we had time and price. So there was timing here. 16th, 19th. And there was key price resistance, this high to this low, 618. Then a 1618 extension, and then a 100% projection. And we have definitely moved back down more than that. I think we got to the 786 retracement. But this is when you really want to pay attention, when you have time and price come together. So that, I believe, is my last slide. So let's get rid of this. I might have to, might add a few more slides before I do that presentation. That's going to be on the 16th here in Vegas. So now, if you have any questions, let me know. So what I may do here is just, I'll stick around in case you do come up with the questions, but I'm going to stop the video here so we can just get this up in the members' webinars.